It's Thursday, March 24th, 2022. And today we're talking about Validere's early pivot pays off with a $43 million USD raise. Talent.com's rebrand leads to a $120 million USD raise. And not to be outdone, two bootstrap companies decide to finally raise some outside financing. The Bank of Canada is working with MIT on digital currency research. And finally, ApplyBoard is making its first acquisition. Let's get started. First up, Validere's early pivot pays off with a new $40 million USD raise. Alex, if it's a pivot, that means they used to do something else. What did they originally do?
Well, Validere originally had a color-changing strip that identified the contents of unknown look goods, and they use it for many different uses. They were trying to figure out the right use. So they helped Chanel determine if someone had knockoff perfumes. They had helped an apparel company make words appear when the clothing got wet. They were working with a diaper company to identify urinary infections. So basically, they had this cool technology, and they were trying to figure out who wanted to use it and for what purpose it had.
Okay, so I heard a lot of fashion and apparel and consumer goods. And what does Validere do now?
Well, it's the most fashionable thing possible. They work with oil and gas companies to better understand the exact contents of their barrels and pipelines. This technology now helps solve a couple problems, but make sure that the oil and gas companies are selling what they say they're selling. People are buying what they say they're going to buy. And basically, this helps improve operations and margins and also lowers carbon emissions.
Okay, so we are going from Chanel to oil rigs. How exactly did they make this pivot to oil and gas?
Well, Validere was part of the CDL program. CDL founders and CDL mentors love the team. You guys need to get focused. And mentor Chun Fong basically flew out to Alberta to meet executives in the oil industry and to see if there was an opportunity there.
Wow, that's incredible. And so big shout out, of course, to, was it the University of Toronto's Creative Destruction Lab?
Yes, it was.
All right. That program really adding a lot of value to the startup here. So tell me about this raise that has come together now.
So Validere raised $43 million US in a round led by Mercuria Energy Group with participation from BlackRock, Nova Fleet, Pioneer Fund, NGIF, Clean Tech Ventures, Greylock Partners, and Wing VC. It's interesting. Mercuria Energy Group is a commodities trader, so not your traditional VC lead. BlackRock is a big fund. BlackRock has interestingly made a statement about focusing on ESG and particularly climate change. So it's interesting to see those two taking a very active role in this round.
Got it. So those are names that we don't say a lot here on Quick Takes, right? So this is sort of a couple alternative players, but also combined with some traditional finance as well, right?
Yep. And look, Greylock and Wing VC are pretty good VCs.
That's pretty awesome. So why do you think they could raise now?
Well, so let's talk about where they're at right now. So they have 45 energy companies as clients that monitor the contents of 6 million plus barrels of oil daily. This is basically let Validere become a leading data provider and a system of record for energy products in the global market. The company also recently layered on a new revenue stream by partnering with Expansive, which is a marketplace, to validate the attributes of the carbon offsets purchased by the market. So that's a lot of activity. This is all led to revenues in the millions of dollars, not disclosed how much, that tripled this year, last year, and that's the third year in a row, so tripling. So you got a company that's tripled 3 years in a row. So why could they raise? There's quite a few things VCs love here. Tractions and the systems of record. Systems of record basically means, hey, this is the place we go for the source of truth. When you have a systems of record, it implies low churn and pricing powers. Very important. Second of all, you see fast growing revenue. That's a big plus. The ability to layer on new revenue streams also shows that, hey, this revenue will continue growing. And there's a certain focus right now on climate change companies, climate tech. So that's also a popular area. So you got a few different reasons where VCs get excited about this deals. Also, when reading about Validere, it seems like the energy companies said there's a huge ROI from paying them. They pay the SaaS fees gladly because it does reduce cost while also improving margins and also helping hit ESG targets. So that also says that there's probably more room to improve prices or at least get more consumer surplus and continue getting new clients. So a lot of reasons that they could raise.
Got it. Do you think that what's happening in the current geopolitical climate in Russia and Ukraine has anything to do with it?
No, I actually think in a weird way that doesn't help them, because when the price of oil goes up, your margins go up, your cost really hasn't. So there's probably less need to worry about cost savings, and probably less need to worry about climate change. I hate to say that. So it probably actually weakens Validere's case as for companies that are just all about the Benjamins.
Got it. That's of course your motto in life, being all about the Benjamins as
Yeah,
well.
that's how I optimize my life.
All right. So if you are a Canadian entrepreneur, startup founder listening to today's news, what's the takeaway from the Validere story?
Well, let's talk about pivots. This is a term that comes up often on this podcast, often in blogs, everywhere. It's become sort of a meaningless word. And lots of times people refer to pivot as, hey, we pivoted our positioning on our landing page. That's what success is. Here gets back to the original meaning of a pivot. When you change either your customer, the problem you're solving, or something fundamental about your business model. And in this case, they pivoted to find a real problem and a customer that's willing to pay for it. And when you find those two, and it's a large market, and you can solve that problem, you don't have to pivot anymore, and you should be able to focus on that and run to build a massive company. So understand what a real pivot is and what a good successful one is. Uh, they start like many startups. Lots of companies I meet with talk about, hey, we have this super cool technology, and then they look going to solve a problem with that technology. It's like, the old saying, if you have a hammer, the whole world looks like a nail. Validere was that at the beginning. Here's a cool technology. Eventually, they focus on one problem, and the funny thing is they don't even use that initial technology that much to solve this problem. They found a really big problem. They found a way to solve it. The technology became an enabler, not the reason you exist. And then I'd say historically, there was two reasons that Validere was able to get the customers on board. Pre the current political environment, the price of oil was under pressure for the last decade. So as oil prices fell, cost became very important. And the second thing, the oil and gas industry was getting bludgeoned to death by investors to cut carbon emissions. You had one software solution that solved both those problems, which helps get you in conversations and close customers. And finally, we've talked about how there's a lot of programs now in Canada, accelerators, incubators, mentorship. This one shows that if you get the right program for your start off and to get the right mentors, it can pay off in spades. So don't just say no to every incubator and accelerator. Find, if you have something you're trying to solve or need some advice, look for the right program.
Unbelievable. What an incredible story this one was. And out of curiosity, how far into their startup journey were there when they made this pivot? Years? Had they raised financing? Do they have partners? Or was it just a couple months into the technology?
I'm not clear. It was early on. I'm not sure how early and if they had raised money before. The funny thing is they had explored some. They did have a project with the oil and gas industry, where I think it was the Ministry of Transportation or something like that in the US had paid them to understand the level of pressure in oil tank carriers and the trains. This is after, remember that explosion in Quebec?
I do, yeah.
Yeah, so I think there was a payment by one of the U.S. government saying, "Can we tell when there's a risk?" And they found that most cars were train cars were not under too much pressure carrying oil and gas.
Yeah,
And
that same line runs right by our houses, right, Alex?
yeah, it's closer to yours than mine.
Yeah. Okay, great.
It's right behind our office.
That's true. Yeah, I'm there right now. Don't look out the window behind me. No. Very cool. I think definitely a great message for everyone listening, which is you never know whether you're on the investment side or you're on the operator side. Stay open, stay curious, stay foolish, and find what works for you. All right. Now, for more insights on what's changing and pivoting in the Canadian tech ecosystem, you've got to subscribe to the TechTO newsletter. Alex, I want you to give us a sneak peek into what we can expect in our inbox tomorrow.
Oh, tomorrow you're going to listen to my favorite articles and blog posts and podcasts to listen to. Can't tell you which ones they are now because I have to decide tonight.
Is this podcast going to be on it?
This podcast is always on it.
All right.
It's just to hear your voice or Alex Riley's voice.
I know. Everyone who's watching today is probably saying, hey, where's Alex Riley? I know. She'll be back soon. Don't worry. So if you want to get that in your inbox tomorrow morning, you got to subscribe at techto.org/. newsletter. All right, next up, Talent.com's rebrand leads to 120 million USD raise. This is strange, Alex. I've never heard of Talent.com.
Okay, just 1 minute, Jason, before you go there. I saw a comment come through Facebook from Francis, who wants to write an article about how to navigate the Canadian startup programs and accelerators. Francis will reach out to you because we're actually working on something in that space and we could use extra hands. So the team will reach out to you, and that's a little preview, something you may see in Q2.
Love it. I love it. Yeah, never ask for something from TechTO because we're just going to put you to work. Let that be a lesson to everybody.
Yeah. Now going back to talent.com, the company used to be called Nuvu or Nuvo. I'm not sure. I think that's a play on Nuvo. It's a Finnish word also. As you can tell, and it's spelled Neuvoo. This limited the growth as it's limited word of mouth. And when they saw Talent.com available for 1.3 million, they purchased the URL and rebranded themselves, which apparently accelerated the growth.
Wait, it was just like buy it now, Talent.com. There was nothing there before. It was just like a landing page saying this site coming soon. Buy us.
Haven't you ever gone to GoDaddy? Apparently, you can click on any URL and buy it. I'm going to buy eBay tonight.
Yeah, that's unbelievable. Holy cow. And what does Talent.com do?
So they're a job portal, and that's the name, Talent.com. They have direct ads from recruiters, and they have third-party recruitment sites that advertise on them.
Mm-hmm.
They grossed 120 million USD in 2021. They, just to give you an idea of the size, they have $30 million $30 million jobs on there from 1 million companies in 78 countries, and they have 20 million active users. And their specialty seems to be target hourly and gig workers.
Interesting. So tell me about the raise. Like what's come together here?
They raised 120 million US dollars.
Wow, great investment. 1.3 million turns into 120 million in investment.
Exactly. That, I'm sure, it was just the URL. They actually did nothing else. And I guess too bad they weren't doing 300 million in revenue. They probably raised 300 million. It was led by Novia with participation from Caisse de Dépôt, Investissement Québec, Climb Ventures, BDC Capital, Fond Action, and HarborVest Partners. The company also raised $3 million debt financing from BMO. So a very Canadian investor base here.
Yeah, a lot of familiar names that we talk about in Montreal and Quebecois raises, right?
Yeah, well, you got a Montreal company that's doing well. All of Quebec wants to get into it.
So besides the fact that they raised $1 for every dollar in revenue, why did they raise so much?
The company claims they want to further expand internationally. They want to invest more in programmatic search and introduce new products. So basically, expand distribution and then expand products to improve monetization.
Got it. And why is this round so attractive?
It's interesting. We always talk about category defining companies, category leaders. Talent.com in the overall job board recruitment place I would say is not a leader. But it has shown the ability to grow rapidly and to execute. So, and the recruitment space is a massive market. So I think what you're seeing here is if you have your unique positioning and ability to execute and grow, there's money out there in a massive market. So let's give you an example. I can think of all these other companies, Indeed, and ZipRecruiter, who target like more SMBs, LinkedIn, who has a network effect and then targets more white collar and enterprise companies, Angels Talent that does startups and engineers. So all these companies have been able to raise, and here you got a company that's got to rapid growth, targeting gig workers and hourly workers. So it seems attractive because people can see that there could be a massive outcome, and this company can get there.
That's exciting. I love a big one like that coming out of Canada. So if you're paying attention at home and you are far away from your $120 million raise, you're still in your Nuvu life stage. You haven't rebranded and dropped $1.3 million on a domain yet. What can you learn from this rebrand?
So first of all, if you look at the rebrand, it's interesting. If you were to ask, it goes back to every rule or every opinion we have here is probably counter opinion or counter positioning which shows success. And I'll start with the brand is important, but isn't important. What I mean by that is in many companies, it's okay to make their own word up and their own spelling, and they're better off sticking with that brand through their career or through the life of the startup, because lots of times you see startups change their brand, they lose the SEO juice, they lose the meaning, and they actually, it has a negative impact. But in this case, you see the problems with a bad brand. So a bad brand is a brand that's consumer focused. This is mainly consumer focused company here.
Yeah.
They had something which people couldn't pronounce or spell, so it made it impossibly hard for word of mouth. I'm sure lots of people ended up on the wrong site, and they went to a simpler brand that was easy to spell, resonated with the consumers. They understood what it meant for, and it unlocked growth, at least unlock word of mouth, which is very important when you're targeting consumers. So first of all, usually I say stick with, once you create a brand, stick with it. But, the second thing is make sure the brand's spellable and easy. And if it's consumer focused, there is times where it makes sense to change a brand. Second thing here is companies, there's lots of venture capital out there. There's lots of financing out there. And there's a lot of different potential investors that may invest in what doesn't seem like every early stage venture capital says, we want a market defining company. We want a massive market. We prefer winner take all. We want the monopoly, but it's not true for the right markets. Like if you have a team that shows it can execute, and you have a market which is massive, the market size and execution will trump the fears about creating a monopoly. Here you've got a market that everyone is, let's say 95% of the world is looking for a job at one point. There's many different types of jobs, lots of money spent on this. If you can build what looks like a niche in this massive market, you can still build a company which has a massive outcome evaluation, and there will be venture capitalists that want to fund you. It might not be the ones that, are household names, but there will be people that put money out.
Yeah.
And then, I think those are the main ones for me. Anything you'd like to add?
I think you nailed it. I think even today on this show, we've pronounced their previous brand 4 different ways. And so what an opportunity for them to step up, and what an opportunity they have to own this space. And right after Quick Takes today, don't touch that dial, because we'll be heading over to the Intuit Prosperity Accelerator AI Demo Day. Don't go anywhere. Join us for a conversation about building fast-growing companies with Michelle Romanow, and learn about some of our favorite Canadian rocket ship startups. Maybe there's a few future talent.coms in there. Join us for free at TechTO.org. Are you excited, Alex?
I am.
Yeah, we did this demo day last year. It was so much fun. I can't wait to do it again. And speaking of some Canadian rocket ship startups, we've got a new segment for you today. Wish we had some segment music, or maybe like a little animation fly up. Wouldn't that be cool? Every week going forward at TechTO Quick Takes, we are going to be profiling a TechTO member company that you need to know about. Alex, what company should TechTO be paying attention to this week?
MASH.
All right. What is getmash.com?
So MASH is helping people to build their business across the web within their control. MASH is enabling what they call pay-as-you-enjoy, which is a value-for-value exchange between consumers and builders, creators, entertainers, writers, game creators, and developers. This is a radically new business model for online content and digital experience across the open internet. MASH pay-as-you-go software lets you charge users any amount incrementally while they enjoy your experience. You can check out more about them at getmash.com.
What do you think, Alex? Are you a fan of the pay-as-you-enjoy model?
Yes, for some sites. Right? It's usually for sites that I'm not going to enjoy that much, or I don't go to often that much. The ones like Netflix, if Netflix charged per minute used in this house, or Disney Plus did, I think we'd be bankrupt, right? So I think there's times where it makes sense.
Sure. Yeah. I mean, I feel like it's a little bit getting closer to some of the models that your kids spend on, in a way.
Roblox,
yeah. Some of those, exactly. Roblox is a little bit pay as you enjoy,
Yeah. Now, if you want to get into a deep, dark rabbit hole, we can talk about how Roblox has to do accounting for the stuff my kids buy, but that's a whole other show.
A different podcast with a different audience that's going to get excited about listening to the inner workings of accounting at fast growing tech startups. But definitely a good one too, Alex. I know you're obsessed with the books. So let's ask our audience, did you like learning about a new TechTO member company today? Let us know in the comments, and we will keep getting better in that segment every single week for you. All right, next up, 2 bootstrapped companies are raising outside financing. Tell us about the stories today, Alex.
2 previously bootstrapped companies, Helcom and Reach, raised their first rounds of outside financing, and both were large.
All right. Well, tell us about each one.
So Helcom, who's Calgary-based, raised $60 million, led by Information Venture Partners and the Aculine Technology Group, with participation from generational platform partners Boris Wertz, who is a GP at Version 1, Jason Smith, who's the co-founder of Clue, Hanif, the co-founder of Cement, and Kevin Sandhu, co-founder of Control HQ.
And the next one?
Okay. Reach, who's another Calgary-based startup, raised $30 million in equity and debt. Hasn't been cleared how much is what's equity, what's that, from Vistara Growth, and high net worth individuals, including Doug Hunter and Del Mondor, and from VC Rising Tide.
And so is there any similarities here between why they didn't raise before and now why they're both raising now?
So both are a bit different. Helcom had the traditional bootstrapped. They started off as a reseller of basically other people's software, and they then basically created their own software in 2019, and basically saw rapid revenue growth in 2020, and needed money to basically grow. While Reach started as a separate independent company within a parent company called Calgary Foreign Exchange. So and they kept on growing, and then they were separated, and they need money to actually continue to acceleration. So basically, it's interesting. You have two payment companies, two Calgary-based companies, solving different problems, got to what I call product market fit, saw growth increase, competitive spaces, and they decided that they needed to raise additional money to continue the growth and be relevant in highly competitive spaces.
And what's your take on bootstrap companies turning to external financing?
So I don't think, look, I'm all for bootstrap companies, right?
Says the
I
venture
think
capitalist. Mm-hmm.
No, I do think a lot of companies aren't meant for venture scale, or the founders don't want to give up the control, because once you get venture capitalists in there, you have a timeline where you're expected to return that capital with a profit to the investors. I think what you've got here is, look, Helcom basically has a multi-faceted payment system, so you can do point of sales, you can do online, offline. Reach is helping e-commerce companies charge, go global, because historically, if you use, let's say, you're a Canadian-based e-commerce company and you charge an American, they might get a foreign exchange fee. They might have additional hidden charges. So conversion rates are low. What they've done is they've had a bunch of subsidiaries and make it very transparent, so you can serve customers globally, and the conversion rates go up and you save money. So both these companies shown they can grow. Both have product market fit. Both are in extremely competitive spaces. So the questions for the teams there is, can we be relevant by the growth we can afford without losing money? Or do we want to raise external capital to burn money, grow scale, be more competitive, and get a better market? So the question for these teams are, do we end up with a smaller piece of a larger pie with additional risk to get there?
Yeah,
and
the classic bootstrap versus VC equation, right?
And the dynamics change while you're growing a business. This is not the first time we've seen this in Canada. FreshBooks is a classic one where Mike McDermott was for years saying, "I'll never take VC. I'll never take VC." Then the space got significantly more competitive. They had reached a scale of a certain size where it made sense to put fuel on the fire.
Yeah.
Same with Rate Hub. So, and I think there's no right answer. I think it depends on the situation. But I think if it's, you're talking something fixed cost, high margin, lots of competition, and massive market, you're probably going to get more push to venture than you think you will.
Yeah, I love it. And hey, waiting long like a FreshBooks or like a 1Password also means you're selling, I don't know, 20% of your company at a really high number, and there's secondary opportunities, and there's a whole bunch of other reasons why it might make sense if you wait that long as well. Very cool. All right. So now we're going to enter into one of your favorite parts of the show, Alex. It's Quicker Takes. If you thought Quick Takes wasn't fast enough, you're going to love Quicker Takes. But first, I want to tell you about our Insiders program. If you want to join the TechTO membership program, it's a community of Canadian tech founders, entrepreneurs, and investors. You got to head over to techto.org and check out the Insider Membership Program. Alex and I are there every single day answering your questions, making connections for you, and helping grow the community. You also get to give us feedback on the kind of content that we make, like we saw from Francis in the comments today. Alex, who have you met recently in the Insider Program?
I've been bad. I was actually on vacation, and my wife took my devices away from me, saying I need to actually talk to her and the kids and be outside and get some vitamin D.
Hey,
So
the best thing that Cello could do is maybe sign up to be an insider, and then you'd be there chatting with Cello all day.
Sounds good. You can make that pitch to her.
I will give it a shot. All right, off to quicker takes now. The first quicker take. The Bank of Canada is working with MIT on digital currency research. Why is this interesting, Alex?
So let's be clear. There's a 12-month research project that's focused on the design of a potential central bank digital currency. Basically they're trying to understand how advanced technology could affect the potential design of a CBDC. I think this is interesting because it further cements the validation of cryptocurrencies. It's a proof that, the Bank of Canada has been looking at this for a while, but the more research, the more time to spend on, the more I think it gives cryptocurrencies validation, not to need any. And I think the big long-term thing here is what's the outcome of this? Because the impact of a potential, let's say, Canadian stablecoin backed by the Bank of Canada, or issued by the Bank of Canada, will have large impacts on startups that are creating Canadian stablecoins. I've seen one or two. It'll also have an implication for the fintech space and the rails which they can offer products on, and the consumer at the end of the day. Because if hypothetically our dollar's already digitized, I don't know what percent of your wealth you go put underneath your bed. I think for you, Jason, I've seen a lot underneath your mattresses. But we deal with digital. But if we go to a digital stable coin backed by the Canadian government, was implied from my day-to-day consumer. So I think the closer the bank gets to issuing a Canadian dollar stablecoin, has a lot of implications down the road for crypto.
So the recommendation from MIT isn't going to be for the Bank of Canada to adopt Doge or something. It's going to be something a little bit less volatile and a little bit more controlled.
I don't know. I hear they're looking heavy into the Putin coin. There is one out there. It's apparently linked to the price of oil. So maybe that's what the way they'll go.
And the last quickest take of the day. ApplyBoard is making its first acquisition. Who are they buying?
They bought a company called Panda Portal, which they quickly renamed Train Hub as the deal closed. And it trains educators and recruiters that will, in turn, attract more students to schools.
And why are you paying attention to this one?
Well, first of all, ApplyBoard is one of our unicorns, so it's interesting to see them make an acquisition. And this is probably a build versus buy decision. And we don't talk a lot about those, but are explicitly talk about them. And ApplyBoard, for people that don't, maybe aren't familiar with them, their model is to go to recruiters in countries like China that help students figure out where they should go for university. And so that their top of funnel is actually not the students, is these recruiters getting the students in the top of funnel. Right. And so this is an ability to educate them on these recruiters on what's going, options in Canada or other countries, wherever ApplyBoard is. So instead of building a bunch of software and content, they bought someone else, which should help basically improve their conversion at the top of funnel. So it's
got it. And were they already partners before? Like this could also just be them capitalizing some of their marketing spend, right? Like maybe
it's not clear. There was limited information in the history. It looks like ApplyBoard already said this was a strategic initiative, and it looks like it was a simple buy versus build. They were probably looking at this. They came across a startup. The cost for acquiring, which was not disclosed, probably made sense. Hey, we'll save 6 months, 12 months. We have a bunch of relationships here. Let's just buy it and accelerate what we're doing.
Amazing. And so what do you think founders should be thinking about? How they buy versus build more often?
Yeah, I think it's also stage dependent, right? If you're buying when with your pre-seed round, unless it's an acquisition hire, it looks probably wrong. But later stage companies, I think buying is underrated.
Yeah, no, we put a big chunk of the first Series A raise to Wealthsimple towards an acquisition, and it was the platform that still powers it to today. So you never know, right?
Yeah, one day we'll release that case study at TechTO.
I can't wait. It's going to be a great one. Thanks, Alex. Holy cow, what a week in Canadian tech. If you haven't already, like and subscribe, ring the bell. Do whatever you need to do to make sure that you keep watching and listening and staying up to date with what's going on in the Canadian tech ecosystem. And I'm going to see you in the TechTO membership community soon.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.